Fiserv stock is down 72% over the last 12 months. Since the top is down 74%. That's huge, okay? Just going down and down and down by a lot. 18% in one day. 17% in another day. 15%. And recently in October, 48% down in like a week. Okay? That's crazy. This is exactly the type of situation where you want to find yourself in. When you're buying, do you have cash? Do you want to buy some stocks? This is exactly where you want to allocate capital, okay? 74% down. Why? Well, it's very simple. Stocks go up and then they go down. And then they go up and then they go down, okay? Hottest stock in the market right now, Nvidia, was down. 2 years ago, 3 years ago, was down by a lot. I mean, look at this. Dipping and dipping and dipping and dipping. Down 60%, more than 60%, 66%, okay? Almost 2/3. This is where you're buying, my friend, when it goes down, not when it goes up. You already missed the boat on Nvidia. Find something else that is down 70%. Netflix. Look at this. Look at this. Same similar falling knife. Very similar pattern because it had a lot of days where it fell like 20%, 25, 30%. Look at this. April to May, let's say 2 weeks, 3 weeks, 50%. So very, very similar price action. During like a year, less than a year, October 2021, May 2022, so less than a year, it went down by 74%. So very, very similar action with Netflix right here. We're going to take a look at all of the metrics. I'm not saying that Fiserv is just going to behave exactly like Netflix did and go up 500% from here. But what I want to say is that the only way to make money by going outside the S&P 500 is by buying low. You have to buy low and you have to rotate your capital always. You either buy the S&P 500 and you're just going to be in line with the market, or you buy low and you sell high and you repeat that process over and over and over again. Okay? So let's just say you bought at a top back in 2021. Let's just say you bought high. Well, you would have done just decently, maybe a little bit behind the S&P over this period, 54%. I'll have to check, but I think it's pretty much in line with the S&P 500, plus or minus 5%. But if you would have bought when it was down 74%, well, now you're up 500%, okay? Huge difference between 50% on your money and 500% on your money, okay? With 500%, you can be very sure that you have outperformed the S&P 500. If you don't need to allocate all of your portfolio to just one stock and make 500% return in 3 years. You can allocate 4%, 5%, something like that, and make 500% on it, and then have a couple of others that maybe outperform, and then some others that break even, in the sense that they are in line with them. When I say break even, I'm talking about being in line with the S&P 500. I never look at the actual results. I don't get excited about making, 20, 30% on my money. I always try to compare to the S&P 500. So, for example, if you make, 30% this year, and the S&P 500 is up 33%, without taking into consideration any dividends and reinvested dividends, well then, you're an idiot, basically, a moron. Why would you be happy about underperforming the S&P? That's ridiculous. So, a lot of situations like this. Meta, huge opportunity a couple of years ago. Was dropping and dropping and dropping. Kind of similar price action to Netflix, and down 76% in a bit more than a year. Okay? So if you would have bought the stock Meta platforms back then at the top, you would have been up 68%. But if you would have bought, let's say not at the bottom, at the absolute bottom, let's just say somewhere after the bottom, now you're up more than 400%. Still a lot better than 68 or whatever it was. Okay, so with these type of returns, you can be sure that you're outperforming the S&P 500. The only way to try to outperform is by buying low, by buying stuff that goes down. Okay, I never buy high. If any stock goes up, that's not for me to buy. I do not put money in something that has already gone up. For example, here I might buy when it dips hard, but not this opportunity is gone for me. It's already bumped 8% from this potential bottom here. I'm not interested. I want to see huge drop and consistent downtrend. I don't buy small dips. I want big dips. I bought Google at 150. That was a good buy. So as you can see here, 28% down in something like Google. That's a good dip to buy. Okay, I bought it, made a quick return. I didn't expect this insane amount of pumping. Live and learn, I guess. But anyway, let's go back to financial services. We're gonna go into the numbers real quick here. But yeah, down 74%. This is where you make money, buying when something is at a massive discount. Okay. And of course, you have to be buying stuff that is good. You have to be buying profitable companies. You have to be buying good companies, companies that you would like to own long term regardless. The point is, you might be buying here when it's going sideways for a couple of years, but you definitely don't want to be buying here when it's gone up by a lot, okay? But now we have a situation where we can buy this type of company at a massive discount. All we need to do now, so the price is good, the entry is excellent. All we have to do now is make sure that it's a very high quality stock. That we're not like Warren Buffett says, you don't mind if the stock market closes for like 5 years and you cannot trade the stock, because you're going to be sure that you have bought a high quality company and you're not going to have many problems over those 5 years by just holding it and not being able to trade it. Okay, so market cap is 33 billion, let's say, revenue 21, PE ratio of 9, forward PE of 7. So right off the bat, no dividend, but right off the bat, forward PE quite a bit lower than the actual PE. And we're working with single digit numbers, okay? So whenever you're working with single digit numbers, all you have to do is make sure that the company has growth, top line growth, and has decent margins, okay? And the single digit P already looks ridiculous. If I see something like anything, I already know the company because I've studied it a lot. It has been part of my investment universe for many years now, alongside PayPal and other stuff. But anyway, if we see something like operating margins of anything more than 10% and consistent growth in the top line, this PE of 7 is ridiculous. You basically want to be buying with both of your hands. And then obviously you have to take into consideration all of the other metrics. Maybe debt, there's a problem with debt. We don't really know why the price has gone down so much. I don't read the news. I don't really care about the news. It's just noise. Do not read the news. Like, you have news here, okay? News. Fiserv, blah, 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 blah. Fiserv, lawmakers, blah, blah, blah. Do not care. Do not read this stuff. Completely irrelevant, guys. Also, you do not want to... They are meant to manipulate you emotionally. So you do not want to read it. You do not want to get manipulated. You just want to take a look at the facts and the stats and the numbers and see where the company is going. So, financials, income statement. Let's take a look by quarterly at the graph. Revenue, top line. So right off the bat, we see here kind of flatlining on this graph. This the first few years, it looks like it's flatlining, and then all of a sudden it bumps. It more than doubles what's happening here. It looks like some kind of acquisition, and then after the acquisition is made, is complete, it's been growing nicely since. So let's just say 5 years, okay? Going from... So for this company, we're just going to look at the last 5 years. Yeah. Growing nicely and somewhat consistently. They have very little cyclicality here, it seems, but nothing too concerning, in the sense that you can basically predict where this is going to go. I mean, it's just in line. Looking at the numbers in percentages, this is just in line with inflation. So this is what you expect to see. But yeah, it's slowing down quite a bit over the past 5 years. Used to have a little bit higher growth, but yeah. So nothing impressive in the top line. Gross profit, let's just take a look. 2 billion and reached around 3 billion. Okay. Shares outstanding. Let's put it back to 10 years. because here we're gonna see exactly what's been going on. So yeah, they've been buying back shares consistently before the acquisition. They made the acquisition, and this is reflected in the share count. And they have been buying back consistently since then. I mean, look, this is beautiful. This is like a 30-degree angle down. Beautiful. This is exactly what you want to be owning long term. I mean, if you showed me this and you would have told me, are you okay with owning this company in the next 7 years? You cannot trade it. You're just going to buy it and hold it for 7 years. Are you okay with owning it? I would say, in terms of shares outstanding, in terms of the action of shares outstanding, yes, I would definitely want to be owning it. They're just buying back their own shares, and in 5 or 7 years, your shares are gonna be worth a lot more. And of course, the price is just gonna go up naturally. I mean, look at this. Nice. In terms of percentages, let's go by annual here. 5%. That's huge. Okay, so they retracted almost 2% 2021, 3.5%, 5% 2023, 5.5% 2024, and the same 5.5% 2025, trailing 12 months. Great. I mean, we're looking at basically 20% since the acquisition, 20% retracted already. Let's look at the margins now. Gross margins going up over time. Let's just take a look what's been going on. Okay. So after they made the acquisition, their margins have not, the gross margins have not gone down, but in the last few years, it went up from, let's just say 50% up to 60%. So that's a very good sign to see. Okay, so before the acquisition, they were doing 26% in operating margins, dropped down, and now they're profitable. They're back at their normal levels, a bit higher than they used to be. So they have integrated the other company very well, and they're very efficient and very profitable. 28%, 29% operating margin. If they just maintain this profitability with a P of 7, I mean, that's ridiculous. Why? Because they're going to buy back more and more and more shares. They're profitable. They're churning in the cash, and their EPS is just going to go up and up and up over time. Look at this. Earning per share, 2, 3.9, 5, 5.4, 6.5, and this is just going to go up and up and up. What does that mean? That means that the share price, it's just not going to stay here for long. I mean, this is probably, I'm not saying it's the bottom. I mean, sure, it can go down a little bit more, but it's extremely unlikely that it's going to go down even more. We're going to look at the valuation and see what's going on here in the valuation category, exactly how cheap it actually is. But let's just take a look at the balance sheet. So 33 billion in market cap. Their cash, they're sitting on a $1 billion of cash. Not all-time high, but healthy amount. They're not at zero. Okay, they have cash. They're not going to dilute you anytime soon. They have put aside, and they can, it seems like they have been doing consistent buybacks, but without depleting their cash pile. So that's very good to see. Goodwill, they have a lot of goodwill here since they made that acquisition, 36 billion. And yeah, seems like in the past 5 years, this has not been going down. Who knows when it's actually going to be writing off that goodwill. But yeah, total assets going from 11 billion to 77. Wow, that's a lot of assets added onto the balance sheet. Yeah, that's weird. I'm not sure what type of company they bought. Liabilities, long-term debt. Okay, so they did use debt to make the acquisition, probably a little bit of stock as well. I'm not sure, but they have bought the company. It's not a merger or anything like that. Then they use debt to buy it, and they have not been paying it off. Actually, they took on more and more debt last few years, which is not what I wanted to see. Ideally, this 21 billion of long-term debt. Ideally, you would wanna see this go down and down. Maybe in 2020 or 2021, when it was very cheap to put in to get more money because of the low interest rates. Maybe these years I would have been okay with seeing an increase in long-term debt, but in the last few years, yeah, I'm not too happy about it. Taking on some more debt. I'm not sure why. What do they need that for? So total shareholder equity, yeah, it's been going down and down and down. I'm not too happy about that either. Total debt, yep, going out. Net cash going down and down and down. So their net cash is minus 29 billion compared to a market cap of 33 billion. That's not extremely worried, but it is a red flag. I have owned in the past some other company with a lot of debt. They were doing a lot of stock-based compensation as well. They were using debt to fuel buybacks, and it just blew up in their face. There was basically a lot of corruption going on with the stock in the management. They were just basically using debt to fuel buybacks and drive the price up, and then they were exiting, they were selling at a much higher price, and then all of the other shareholders were left holding the bag. So you do not want to see excessive stock-based compensation and share buybacks fueled by debt. That's what you want to be staying away from. So now cash flow, in the statement of cash flow, we're going to take a look at the stock-based compensation, if it's excessive, and then also at share buybacks. Okay, so net income 10 years ago used to be 700 million. After they made the acquisition, as you can see, jumped up massively. Trailing 12 months, $3.6 billion of net income. This is a lot. This is very, very high for a market cap of 33 billion. I mean, this is excellent. This is exactly what you want to see. Now let's take a look at stock-based compensation and compare as a percentage. Looks to me that it's a little bit more than 10%. This is, again, green flag, okay? Nothing too excessive. I mean, even before they had 370 million, drop down a bit. Now they're at 400 million. For the amount of money that this brings in and the type of growth that they've had in the net income department, I would say this is a green flag for me. For the type of margins and the company that it is, it doesn't have a lot of revenue growth, but all of the margins are very high and improving over time. So I'm glad to see that they do not have excessive stock-based compensation. Repurchase of common stock. Wow, that's a lot. I mean, I did not expect this. $7 billion last trailing 12 months. They did $5 billion in 2023. 5.8 billion. I mean, this is just going to be at these price levels. Yeah, they were doing this type of buybacks when the company was worth more than $100 billion probably. So they were still retracting around 5% of the company during these years. But now, if they do next year anything close to 7 billion or 5 billion, I mean, what's in terms of percentages, what's 7 billion? Almost 20% out of 33 billion. I mean, that's ridiculous. More than 20%. So let's just say that nothing changes. Let's just say they add on to the long-term debt by a little bit, and they do another $7 billion of buybacks. Let's just say 5 billion. Let's just say there's some issues with the company and they have to slow down the buybacks. 5 billion, and the company is worth 33 billion right now. I mean, that's still a lot. I mean, that's quite a bit more than 10%. Let's take a look at market cap. So growing nicely until 2019, where it jumped, more than doubled actually. It doubled and then it went from there, going sideways for a while, growing this year, and then it started to crash back down to 33 billion. So wow, this is crazy. I mean, this is crazy. Yeah, the market cap now is lower than it used to be in 2019 before the acquisition. That's nice. Nice for me because I have this opportunity. I have already bought it, but I might add some more because let's just take a look at my portfolio here on eToro. Fiserv, I allocated 4.2% of my portfolio, and the price I bought it at was 72, and then added some more at 65, and now it's sitting at 61. I might add some more. Average open 68. Not too bad. Didn't catch the bottom because I was very happy about. I mean, when it dropped 40% in one day. I mean, I just bought it then. I just bought it here, 65 here. So I'm very happy with my entry point. Let's just see. in terms of valuation, where are we? PE ratio. Used to be valued at 100 PE ratio. What? 80 PE 2021? That's crazy. 60 going down and down. I mean, the price action went sideways for a while, and seems like the valuation corrected massively. And then it was stabilizing around 25, 28 for a PE ratio. And now it's at 9. That's ridiculous. 4 PE. Down in the toilet, 7. EV to sales, all-time low. EV to EBITDA, 6.7. This is ridiculous. This is absurd. For a company that has 70% gross margin, 60%. %60 gross margins, 28% operating margins. I mean, with these kind of margins, having this kind of valuation, this is absurd. This is ridiculous. But even Meta had this type of EV to EBITDA at once. It was trading at 7 times back in 2022 or 2023 when it was crashing. So return on capital invested, 7%. Used to be higher. Maybe they can get back to 12%, which is very nice. 11, 12% for this type of company is not that bad. But these even 7% and 10% return on capital employed is going to be okay for the type of valuation that you're getting it at. FCF yield, 14%. This isn't, even before it crashed, it was trading kind of, I wouldn't say very super cheap compared to the market, but yeah, considering the fact that it doesn't have very high growth to the top line, yeah, it's been trading at a normal level, 4%, 5%. These are just normal levels. Now it's like 14%. Well, this is an opportunity. This is exactly where you want to be buying. Yeah, any company goes down. Nothing is too solid not to be brought down, okay? Nike, a giant. You look at Nike, 75% down, or how much is it? Everyone thought this was never going to go down by this much. I mean, look at this. Nike, very solid. Down, boom, 70%. Target. Everyone hates Target now. Used to be a very high quality dividend stock. The dividend guys were loving this stock a couple of years ago. Down 65%. What goes up a lot must come down. The higher it goes, the harder it's going to crash. So stuff like Walmart. Okay. Stay away from Walmart, guys. I mean, look at this. $800 billion. I'm going to make a video about all-time high. Look at this. You basically want to stay away from this stock. I mean, it's just going to come down crashing 50% or more. Next recession, for sure. I mean, you're going to see these levels again. Like 40-something, 45 or so. Anyway, this has been Fiserv stock analysis. Great opportunity. I have it in my portfolio. I do have some cash positions here, such as Texas Instruments. I might sell Texas Instruments and buy some more Fiserv. PayPal as well is looking very nice. PayPal as well. I mean, kind of a similar story with PayPal. Not the same type of company, but same type of growth rate, 4%, 6%, 8% last couple of years. So same kind of growth rate, same kind of margins. Actually much lower, 41, 18. Yeah, PayPal is much lower. So gonna be deserving a lower multiple, but shares outstanding, they are doing a lot of buybacks, 2%, 4%, 6, 6.5. As you can see here, they have been able to retract a very high percentage of their outstanding float. So PayPal stock is another stock that I own actually in my portfolio, but it's it's an okay opportunity. I'm not getting excited about it because it doesn't have consistent high growth and it's just slowing down more and more and more. But looking at the PE ratio, 4 PE, 11, EV to EBITDA, same kind of story. In the toilet, very cheap. Maybe it's going to pick up again, maybe not. But just by looking at share buybacks, this should be a very good buy as well. Let's take a look at the cash flow. Net income, 5 billion. They're doing quite consistently over the last 5 years, more than 5 billion. Stock-based compensation, a lot higher than financial services. This is probably the reason why one of the reasons why it doesn't want to go back up. I mean, the stock-based compensation is just a bit excessive. But anyway, they are doing repurchases. I mean, look at this. 4 billion back in 2021 when the company was worth almost 300 billion. So doing 4 billion of buybacks then, complete waste of money. 2022, complete waste of money as well. Well, now it's getting better. 2023, it's already been crashed at this point, and they were able to retract a lot more. 5 billion, 6 billion, 6 billion now. So yeah, the management here, you can see that it's not very smart. They're not very smart people. They were worth at one point almost as much as JP Morgan, saying they were just burning money through buybacks. I mean, it's so bad, it's so stupid. I mean, look at this, guys. 342. I think here in June 2021, they were probably worth more than JP Morgan. And they were doing buybacks. Yeah, of course, the PE ratio was absurd. I mean, look at this. 80 PE ratio. 70. But yeah, that was it for Fiserv and a little bit of PayPal. Okay, so I wanted to add this as well. We're on that Aroma site. You wrote here Fiserv. We want to see who owns it, who bought it, who sold it. Ownership count 12. That's quite a bit. Percentage of all portfolios, so 0.2%. I'm not sure. I think that's quite high, to be honest. I think at the most Apple has like 2% or so. But anyway, as we can see here, just green. Green. Just Tory funds has shaved 2% from his portfolio, from his position actually. So Dodge and Cox, these guys are huge. They manage over $100 billion. They have 3.4 billion into it. Let's take a look at Dodge and Cox. I'm not sure who is the manager here. Anyway, yeah, Fiserv is up here. I mean, number 5 position in a fund that manages $120 billion. They don't move very much. Let's see activity history. Fiserv used to be number 1 in their portfolio back in 2024. That's very interesting. Let's take a look at history here. History of shares. 2020, 2021. So they bought it in 2020 for $100 per share. They added on to it, got up to about 23 million shares, held it, then took some profits. And now, since the stock price has crashed, the reported price here is 128. They added 31% last quarter. Good to see, great to see. I mean, they have our back. Maybe, I'm not sure if these are the guys who might have sold. I'm not sure what's going on, but yeah. 3.4%, almost 3% of portfolio they allocated to it. Then 2.8, 2.5. Seth Klarman. I'm very interested in what Seth Klarman does. If this guy bought it, actually, seems like he has been owning it for a while. First time bought it in 2021. Interesting. So Seth Klarman, David Tepper. I follow this guy. I like what he usually buys. And yeah, that was about it. But yeah, anyway, we see a lot of buying and adding to it. Not a lot of selling. Nobody sold. Just this guy just shaved a little bit from his position. It's nothing. A little bit of rebalancing, but yeah, just buys and adding to the position. Great to see when all of the super investors are in line with what you want to be doing. Very curious to see next 13F filings to see what's been going on here. Why does the stock fall so much, but the super investors, maybe they don't have as much influence over the stock price as I thought they had. Anyway, yeah, that was it.